Have you ever imported goods through a consolidator? Then when you least expected, KRA comes knocking at your door claiming for you to pay more taxes. This is a story that many traders know too very well here in Kenya. You import your goods, you pay taxes at the port of entry, you receive the goods, and you continue with your business as usual, till KRA surprises you with an additional tax assessment. And the problem is not about the goods that you have imported, but it's about the VAT trail from importation to the sale that you finally did in your shop. A consolidated cargo works like this, and it is one of the most preferred methods of importing goods from abroad. So we have someone referred as a consolidator. This person is a good person because he consolidates, he collects small shipments from traders abroad, then combines all of them and put them in one container. He handles customs clearance for this container. They pay the VAT fees for the import, they pay the import duty, everything they do for the small traders. But now this is where the tax risk starts. The consolidator uses their own KRA PIN to pay for the VAT. However, he will not sell these goods. Once the goods arrive at the port of entry, that is in Mombasa, he will clear those goods on behalf of the owners and then releases the goods to the owners. So what has just happened is that the consolidator has input VAT, the VAT that he has paid at the port of entry. But this person has no output VAT because he has not sold these goods. On the other hand, we have the trader who has received these goods. He's very excited. He goes and sells these goods. Once they sell them at a profit, and by doing so, they attract VAT output. Unfortunately, they don't have the input VAT. Why? Because the importation was handled by the consolidator. The KRA PIN that was used to pay for the VAT, import VAT, was for the consolidator. So the trader finds themselves in a very awkward situation. They have output VAT, but no input VAT. Actually, this mismatch can easily cause KRA to give you a tax assessment, impose penalties on you. When we have a very funny situation, the consolidator has input VAT but zero output VAT. This means that when he files for taxes, his KRA account has a credit balance. KRA does not want that. On the other hand, for the trader, he has so much output VAT but zero input VAT. He is struggling to pay the output VAT. And KRA also does not want that. They usually issue such a person with an additional tax assessment. The question is, how do we resolve this? The only way to resolve this is for the consolidator to issue a VAT invoice for the good value of goods that he sold or imported on behalf of the trader. Then he needs to go a step further and declare that invoice as output VAT on the KRA portal. And the same invoice VAT will be claimed by the trader as input VAT. And that small step aligns the VAT records on both sides and prevents KRA from giving them tax assessments, because KRA is able to see the full movement of value from importation to the seller. Now, what we need to do, and the call to action for both the consolidators and the trade importers, those people who import, always ensure, and it's good to know this, that VAT compliance is not about paying VAT at the port of entry, but it's also about demonstrating the full movement of value from the port of entry to when the goods will last be sold. So therefore, every other time, ensure that as a consolidator, you issue a VAT invoice, and then for the importer, the trader, to ensure that they match the input VAT with the output VAT when they are declaring the VAT payable, and to always ensure that they keep proper records. Because when you do that, you ensure that you close the VAT loopholes, and by doing so, you open the door to your peace of mind, the door to your business growth, and you gain freedom from KRA tax assessments.